Everyone, welcome back to the channel. We're at, I think, week number 3. For those of you who don't know or are new to the channel, my name is George. I work in capital markets by day, and by night I stare into my phone and speak to my phone in a condo alone. Just kidding. I create content and host a podcast and a few other things. Anyways, no coffee today. I got some tea. Throat didn't feel great today, so just trying to take care of myself. It's lemon and ginger. So cheers to that. This is going to be a pretty special episode, hopefully unique, but maybe more like it. It's going to cover the planned IPO of a tech company in the Arab world called Anghami, which some of you might be familiar with. This is the Arab version of Spotify. So I'm excited to cover it. 2 reasons here. I wanted to cover it, one, because I shared the press release yesterday on my Instagram story. A lot of people loved it. They shared it, reshared it. And I also got a lot of questions from folks who are not necessarily in the finance or capital market space, and just wanted to understand what the structure really meant a little bit deeper. So I figured that this might be helpful for those just interested in learning about it. But then 2, to be honest, it was just some positive news, especially as it relates to Lebanon. For those who don't know, Anghami actually was founded in Lebanon in 2012. We'll get into the history in a second, but it started in Lebanon, and obviously with the situation currently going through a financial collapse, the dollar is equivalent to 10,000 Lebanese pounds. Just to give you perspective, there's a boatload of challenges with the government at the moment. And anyways, we're not going to get into that in this episode. Needless to say, there's a lot of negative things happening in the country, and this is at least one positive milestone that we can, call it a win. But it's also a great indication for aspiring founders. Before we get into the Anghami deal, one of the things I did want to touch on is this is a great example of innovation where you don't have to go out there and create a brand new idea, right? This is an example where you're able to look at an idea or a company that's working, maybe in a different market, and try to not replicate is not the right word, but also customize it in the region that you're trying to serve, specifically to the customers, to the culture, maybe to the religion, whatever uniqueness it has tied to the market that you're trying to serve. You're able to customize it, right? Make it more unique to who you're trying to actually serve. And I think that's what Anghami did fantastically, did really well. You have Spotify, obviously, but Anghami essentially serves the Arab world, right? So they have local musicians, the ones that we all know, but also underground, up-and-coming artists. So it's a really interesting platform for that. But we've seen that concept happen not just in the music streaming platform world. We've seen it with comparables like Amazon or Souk.com. We've seen it in the ride-sharing app space like Uber and Careem. So we've seen this countless times. Just maybe a quick reminder that for all aspiring founders listening to this, you're able to take an idea that's working in a market and then actually figure out how you can customize and scale it in a market that's more specific to a certain type of culture. So just a reminder, maybe and hopefully we'll have more Arab tech entrepreneurs start the future Anghamis and companies of this magnitude. Anyways, let's jump in the deal. Let's figure out and kind of dispel this structure, what it all means, and hopefully I can help as much as I can here. So Anghami was founded in 2012 by 2 co-founders, Eddie Maroun and Iri Habib. It was basically launched as the first music streaming platform across the MENA region, so Middle East and North Africa. It offers more than 57 million songs to more than 70 registered users with around 1 billion streams per month. This source, by the way, is literally the press release that Anghami released on talks.anghami.com. And it's interesting because if you look at the Arab-speaking population, it's over 450 million globally. And so this is, their plans basically to go public is one way to scale that. They have more than 56 million data points from their user base every single day, and they're able to use things like artificial intelligence and machine learning not only to leverage that data, but to actually look at and predict user behavior, but also things like trends. And that basically allows them to focus their investment areas in figuring out how to deliver the best or the highest return for current and then future users as well as they continue to grow. Although the company was actually founded in Lebanon, they, I think, unfortunately had to move their headquarters to Abu Dhabi, which is one of the Emirates in the United Arab Emirates or the UAE. I think largely because of just the situation in Lebanon was not conducive to them staying there. I think that's my personal take. I don't know if that's actually the case. But anyways, their actual headquarters now is in Abu Dhabi, but they still have offices in Beirut, Cairo, Dubai, and Riyadh, spread out across the Middle East. One of the last things just to touch on, they have raised money in the past. So they've raised money from some of the leading venture capital firms, strategic shareholders, but also telecom companies. And all those groups, minus like the founders, they own roughly 68%. So the remaining balance is what the founding team actually owns, maybe a little bit left over for employees. I'm not exactly sure of the split, but we'll find out when they actually end up going public. And so that's a little bit of history on the company. Let's dive into the actual deal terms and you know what they stated in the press release. Let's break that down, and I'll hopefully distill a bit of it. So the first part, and I'll read it to you, is it says Anghami will become the first Arab technology company to list on NASDAQ, a major US exchange, via a merger with Vistas Media Acquisition Company, Inc., a publicly traded, this is the important part, special purpose acquisition company, which raised $100 million in August 2020 in their initial public offering. Okay, so this is where a lot of the questions were. Like, what the heck is a special purpose acquisition company? It's a fucking mouthful, all right? SPACs, or I'm just gonna call them SPACs from now on. I think we know what, I don't have to say it every single time. But basically, SPACs are usually referred to as blank check companies. And the reason being, SPACs don't have any operations. These are vehicles or entities that only have cash on the balance sheet. So typically, a couple of directors or officers come and create this entity that's empty on the inside. It only has cash, and they raise this cash basically through an IPO. So they take this entity, this vehicle, public, but there's no real commercial operations on the inside. Now, if you look at the name, notice the subtlety in the name, right? Special purpose. If you look at what special purpose means, well, this means that the money that this entity or vehicle raised is going to be used for a special purpose, which is merge with or acquire a target company, which is why the other portion of that name is acquisition company or corporation. So the funds that are being raised, and this is kind of maybe the interesting part, roughly 90% of the money that's raised has to be put into this like holding account, or escrow is what it's referred to, meaning that the funds are being held and they can't be used for anything other than being used towards actually acquiring an operating company. And typically these SPAC IPOs raise, and they have to raise a minimum of 30 million. In this case, Vistas Media Acquisition Company said they raised 100 million, and now they basically try to go out and find a target company. In their case, that target company was Anghami, and they came together on the table. They basically, chatted about deal terms, what the structure is going to look like. Both parties were cool with it, and here we are, right? So that's typically what SPACs are by definition. There's no maximum size to the target company. So the company that is in question, like let's say Anghami, or maximum size that the target company has to be. The only thing that you should know also is that there is a timeline. So the actual founders of this special purpose acquisition corporation, they typically have 3 years to find that company, the target company, and either merge with or acquire it. So basically, like, this private company, in which case this is Anghami, actually vends into this special purpose acquisition corporation, and it's usually split up into maybe 3 or 4 steps. The first step being, like, you create the actual special purpose company. You then sell the shares. So immediately after listing, at least 90% of those funds that were raised through the IPO get put into escrow. Then step 3 is actually completing the acquisition. Basically identify a qualifying acquisition, and that has to be done within 36 months. The target company in question has to be at least 80% of the value of funds in escrow, in that holdco or hold account that we talked about. Basically then, all the SPAC has to do is file an information circular. It's basically just a document to highlight some of the information around the target company. A majority of the public holders of the SPAC have to approve the transaction. So when I say public holders, this is when the SPAC actually goes public, does their IPO, in which case, let's say Vistas Media Acquisition Company, when they raise the 100 million, the 100 million that comes from public holders, the majority of them have to approve the transaction before it goes through. When it does, the asset or the business is acquired and the resulting entity ends up being publicly traded on the exchange in question, in which case this is NASDAQ. So you're probably seeing and reading up on a lot of SPAC IPOs. Just in 2020, in the US alone, 248 SPACs went public. They raised gross proceeds of $83 billion. So far, just this year, 216 SPACs that raised close to $70 billion. So the trend seems to continue. Typically, like, why would companies go public through this route? Specifically in the US, it's usually a quicker timeline to list. So you're looking at like 3 to 4 months versus the typical 6 to 9 months with a traditional initial public offering or the IPO. In some cases, also the reporting requirements, so the requirements on a company in terms of them reporting when they're public, they tend to be more flexible. Direct and indirect expenses associated with going public through this route could be lower than the traditional listing process. So that's kind of just a very high level on special purpose acquisition companies, in which case that's how they're saying that they're going to go public through. So in this case, the transaction is expected to close in Q2 of this year in 2021. When they were valuing Anghami, they use enterprise valuation. In this case, this refers to the company's total value. It was approximately 220 million, or 2.5 times their 2022 estimated revenues. So basically, you take their projected revenues that the company expects to make in 2022, multiply that by 2.5. That's how you get to the $220 million valuation of the company that was stated in the press release. So there's this other piece to this whole transaction that we can touch on, and I'll read it really quickly. So it's basically that they were saying that Shua Capital, which is one of the UAE's basically largest asset managers and investment banking firms, along with Vistas Media Capital, the parent company of the actual SPAC, they gathered commitments of combined $40 million, $30 million from Shua, $10 million from Vistas Media Capital in a PIPE financing, PIPE. So they combined $40 million. What does that mean? Well, a PIPE usually is referred to a private investment in public equity deal. So private investment in public equity deal, basically that means that private investors, and by private here we're talking about, or think about, like larger institutions, mutual funds. This wouldn't be like your average investor or retail. And these larger private investors are able to buy publicly traded stock, but at a discount of what the actual price that would be available to the public would be. So they're basically buying it at a discount to what maybe you and I would buy it at. They would buy large chunks of the stock at basically a preferred price. Think about this as like a wholesale deal. It's kind of like when you go to Costco, you buy like 6 kilograms of Quaker oats. It's I guess analogous to that. You basically buy larger chunks, and for the company in question, that's just the ability for them to raise more money, and usually more money quicker. That's kind of the overall structure that they laid out. Anyways, I'll attach the press release in the description box. Hopefully this was helpful, just to kind of distill what SPACs are, what the makeup of this transaction is. Just a disclaimer, I'm not recommending this company, I'm not recommending this future stock. I just wanted to do this for informational purposes only. And I thought it would be of value, especially to a lot of like friends, relatives, or whoever was asking me about this stuff. And hopefully just trying to distill a lot of the finance jargon that sometimes could seem intimidating, or to also save you the hassle of having to Google every single thing that you might not catch on to. Anyways, hope you find this of value, and let me know what you think. All right, make sure to like, make sure to hopefully subscribe, and I'll see you next week.